Hello, Jana. How are you?
Great. How are you doing?
I'm good. I'm good. My desk looks dusty on that shot. I know. Dusty desk. How are you?
I'm wonderful. How are you doing?
We are just gearing up for the 4th of July weekend. How about yourself?
Same. Yeah. It's
Yeah.
we do have Friday off at our office, which is nice. We love a holiday.
Yeah. And you work in a 1031, like you work with a 1031 company?
Yeah. So
Which one again?
I'm the VP of Business Development at API, so Asset Preservation Incorporated. We're a
Okay.
1031 exchange QI. Yeah.
And what state are you out of again?
So we're a national company. So we do exchanges nationwide, but the headquarters is in Roseville, California. So that's my home base, even though I'm in the field most of the time, but that's my home base.
That's great. We just completed a $4 million 1031 exchange for a client. Like I worked in the other end of the spectrum, like the exit strategy side of the spectrum.
Okay.
And we guys sell a commercial piece of real estate in San Mateo,
Okay.
and we helped him find 7 properties to buy that were going to be Airbnbs. So he wanted to like stop owning the one asset in San Mateo where he was leasing out pieces of his building and instead convert it into things he could enjoy in retirement and have my team deal with the day to day.
Oh, I
And
love
so
that.
but we always want nationwide 1031 exchanges we can use. Like the last one I used was here more locally in the Asheville, North Carolina area. I just
Okay.
wasn't super impressed with their communication. And I think that really is the ball game. Like, are
Mhm.
they really communicative so that no wires get crossed? That just seems like the ball game.
So there are a few things to consider when you're choosing the accommodator. For sure, one of them is clear communication, their expertise, like how many exchanges they've handled, are they nationwide? Because some of them are not. But honestly, the most important thing are the security measures that are in place to protect the funds during the holding period because the QI industry is actually unregulated industry. So
Really?
there are most people don't realize that they just assume we're like a bank because banks are so highly regulated. They just assume because we're holding sometimes billions of dollars that belong to other people, right?
Yeah,
At
for sure.
any given moment. And so you would think, or most of the consumers think, that we are regulated and that we have to have certain requirements met, but that's actually not the case. So there's more restrictions around who the QI can't be in relation to the investor than what the QI has to do while they're holding the funds to protect them.
That's interesting. We had an escrow company back in my previous career in financial advice, and they had sent money across in this type of relationship
Okay.
where client sends money, it's held in escrow, client signs off final documentation, they send out funds. And the escrow company worked more for the end recipient and released funds without signature. And like on our end, the deal wasn't even done. Like we had a client who was like, "Nah, send me my money back." And they're like, "No, they sent it on without signatures, without closing documents, without."
No. Oh
Oh,
my gosh. That's
yeah,
crazy.
no.
Yeah,
Yeah,
no.
it
So
was, it
we're,
was
yeah. Oh, sorry to interrupt. Go ahead.
No, I agree with you. It's important for people to understand that qualified intermediaries are going to hold your money and that they have to be responsible and have securities precautions in place. I agree 1,000% with the
Yeah.
sentiment. Is it your industry a lot better than me? Is it something that happens every once in a while that qualified intermediaries screw with funds and go to jail?
Yeah, though, so if you want to watch an episode of American Greed, there's one on exactly that, a QI that had millions and millions of dollars that belonged to other people and took it out of the country and eventually got caught, but all the money was gone, right? So those people didn't get their funds back. But yeah, it's a really fascinating thing because people just assume. And so what happens is the consumers will shop around based on the fee, and they don't actually understand that what you really care about is who is this company holding
Yeah.
money? What are they doing with it while they have it? Is it staying liquid? Is it protected? Is there any insurance in place? Like all of those things are far more important than anything else. So we're 35 years in the business. We've done over 200,000 exchanges nationwide. We are actually owned by Stewart Information Corporation Systems, which is a publicly traded company. That company also owns Stewart Title, which is a national title company. It doesn't mean people have to use Stewart Title. We have an affiliation. But the reason it matters to our consumer is because we actually have adopted all the same security measures that the national title company uses. So we use Certified, which is like a wire confirmation software. We use that for all the wire transactions to prevent wire fraud. We have some ironclad legal documents associated with the transactions. All of our investor funds are segregated. So some of our competitors just commingle everything. We don't do that. We have everything segregated, and the money's always liquid, ready for reinvestment at any time. We have FDIC insurance in the accounts, but obviously FDIC insurance has a limit to it. So we also have a letter of assurance signed by our parent company on every transaction. We have E&O insurance. So it's like a multi-layer security system that we have in place to protect the fund. So consumer is rest assured the money is going to be there when they're ready to reinvest it. Yeah, I hear horror stories periodically, and they're not always like somebody stole the money. Sometimes it's just that somebody invested it and the money wasn't ready when the investor was ready to reinvest in the replacement property. The QI said, "Oh, sorry, the money's not available right now." It's what? That's their money. So,
That seems wild. And that would screw with the time frames on the 1031, the whole nine yards.
100% it would. Yes.
It's just, it's so interesting because I have these conversations. We've done 1031s, right? Like I run a company called Bedrock Investment Property, and we help people find, vet, buy, and then we have a sister company that helps them manage the day to day. Like we set up the LLCs and we deal with the property managers. We hire vet property managers. We keep the books safe. And my interaction most time with 1031 custodians is people are looking to 1031 out of poorly cash flowing property. They
Exactly.
want, but they want to stay in single family residential. They don't want to go REIT. They don't want to go DST. They don't want to go syndication because they're like, I don't want to give up all my control. I don't want to give up the
Right.
ability to finance. I don't want to give
Hmm.
up my ability to sell the property when I want. I don't want to give up my time frame control. I don't want to be forced into this thing for 7 to 10 years. And people who've had DST experience and had syndication, like I was just on the phone with a guy Friday. I inherited $1 million. I put it into all these syndications. I've lost at least half of it already. He's like, they just blowing up one after another because interest rates went through the roof, right?
Uh,
And none of these syndications in that time frame, let's say 2.5 years ago, I saw their pro formas and they were all like, hey, we're going to assume a 3% interest rate or a 4% interest rate. And then interest rates go to 8 and they force to refinance. They blow through the liquidities and they're like, okay, we're losing money. And we only owned 80% of this thing, or yeah, no, we borrowed 80% to begin with. So we're going
yeah.
to lose this asset. And that's why I didn't like DST syndication REIT is because I just thought if it goes wrong, it goes very wrong. Where single family residential, I love the simplicity of the asset. The problem is
Mhm.
it's just a pain in the butt. It's just a headache.
Yeah, there's a lot
And
of managerial responsibilities for sure for the
oh, for
investors that
sure.
are, yeah, going that route.
Yeah, for sure. And so what
Yeah.
we said is, okay, at Bedrock, let's sell the aspirin, right? Let's build a system that's comprehensive that can deal with all the day-to-day bull crap. And let's just say, hey, the aspirin costs this much, which is equal to or less than what I would have paid in a syndication or what I would have paid in a DST or a REIT. And that's one of the big reasons that we did it is just because we said, I think there's a slice of the clientele out there who just want to stay in an asset class that if I suck at this, that they can just step in and manage their single family
Mhm.
residential in Memphis. They know how to deal with a property manager already, right? They know what single family, there's like one income line and seven expense or 12 expense lines. It's like anyone can step in and do that without it being the moon. Whereas if you're involved in like a 350 unit syndication
Yeah.
rehab in Austin, Texas, and it starts going south, it's unless you have tens of millions of dollars and experience, you can't step in and save it. It's like this
Yeah.
thing is just going to go right into the ground. And so, yeah, that's really how I have interfaced with 1031 exchange custodians. But
Mhm.
what fascinates me is every single one of these calls I'm on, your approaches are all so nuanced and different. Like you're the first person who's been like, hey, it's the security measures on the back end to protect the money that's important. I've
Mhm.
heard from other people, they're like, hey, it's the relationship and the fees. Like everyone, it's so fascinating. That's why I keep doing these calls because it's so fascinating to hear that your experience are like, hey, security measures and embezzlement. And I'm like, woo, I haven't had that experience. I've never had a 1031 exchange qualified intermediary embezzle, but I have seen embezzlement in my career. And so, yeah, that's scary, Jana. That's scary stuff.
It is scary. I do agree also that the relationship matters. I think the expertise matters because a lot of these exchanges, they can be pretty complex. If they're doing a consolidation exchange where they're selling multiple properties on the front end, maybe consolidating the proceeds into one replacement, or maybe they're doing the opposite where they're selling something and now they're doing a diversification play, and there's a lot of moving parts, right? Or sometimes we have somebody doing a reverse exchange or maybe even a reverse that's partially a reverse and partially a forward because they have so many properties and some of them are getting sold easily and others are taking a long time, but they've already got their eyes on this new place that they need to close on. We see a lot of creativity on the exchange side of things. And so I would say that having exchange counselors that are very skilled is also critical. And so whoever is answering the phone and able to guide the investor and the professionals involved, because a lot of times the real estate professionals involved, they may not be touching exchanges every day. And so even though they have some familiarity or maybe some experience, they need support, right? They need some support on figuring out how to best deal with the mechanics of the exchange. So at our company, because we're 35 years in the business and a lot of the people within our organization are very skilled people, even the president of our company is one of the people that answers the phone to guide the investors through the process. Because what we want to do is we want to make sure that the answers to the questions are right there during that first call so we can vet out whether or not an exchange even makes sense because sometimes there's no deferral to be realized, there's no taxation to be realized, so then deferral becomes inconsequential. So it's like, why would we do this? And so figuring that out, asking the right questions, like who is the tax owner? What's the profile of this? How long have you owned the property? Did you exchange into the property? So there's a lot of questions that we ask to try to make sure that whatever's going on makes sense. And then also encouraging that tax owner to have done some investigation with their own tax advisor because obviously if they've done a cost seg study or they've somehow expedited their depreciation, sometimes there's a lot of tax implications that maybe the investor's not aware of because they think they don't have a lot of gain, but they don't realize there's going to be depreciation recaptured as well. So anyway, long story short is our team is very educated on the subject matter and we're ready to answer those questions. And I think that is also a key component to picking the right QI because you want to make sure you're getting guidance up front that makes sense, right? That
Yeah.
gives arms the person with high probability of success because exchanges do get blown sometimes and sometimes it's for lack of understanding of the tax code.
Yeah.
Yeah.
No, it's crazy. I'm in my office right now, but I've got a whiteboard right here.
Oh, nice. Okay.
And just the other day, we were recording, trying to give people a simplified understanding of the difference between marginal effective tax rates
Okay.
and deductions. And after recording like a 24 gigabyte file, like a 50-minute conversation on trying to help people just understand how the progressive tax rates work, I
Mm.
was like, there's no way. There's no way. Like, you're in the same boat that I'm in, which is you've just said in that one snippet, which we're going to snip out because it was so great of like recapture depreciation and did you 1031 into it and did you do a cost seg study? Like, you just said at least 8 phrases that people are going to watch and be like, and then she started speaking damn Greek in the middle of this podcast. She started speaking another language. She was talking about flobo capacitors all of a sudden. And it's just because the tax code is so immense and so dense. It's just like intentionally obtuse. And so
Yeah.
we tried to do it the other day where I was like, okay, we're just going to walk through the progressive table and how it works. And 50 minutes into it, I was like, screw it, I quit. I can't do this anymore. It's too complicated to explain to a layman. And yeah, okay, so let's take this. We just jumped in, and I love you forever because I love people who are just like experts. Okay, take us back to the beginning, and maybe we'll do a
Okay.
little role play here for the people who are listening who don't know anything about a 1031 exchange, right?
Yeah.
From zero.
Yes.
Explain it to them like I'm a 5-year-old, just so they
Okay.
understand what we're talking about. Because yeah, there's the phrasing coming out hot and heavy that they're like, "What the hell's a cost seg study?" And like, all right, so just like I'm a 5-year-old, walk me through the basics of a 1031, and then I'm gonna walk through. I'm gonna like ask questions and let you talk me through how you would think about that question, so that they can start pulling it apart and realizing what expertise looks like. Does that sound fair?
Sure. Yeah, absolutely. So 1031 exchange is a tax deferral strategy, right? It allows an investor of real estate to reallocate their real estate portfolio with a tax deferral. So they're actually selling what they have in their current real estate portfolio, as long as it's real estate and it's held for trade, business, or investment anywhere in the US, then it could potentially qualify for 1031 exchange. They can sell that asset, and instead of having the money come to them, the money goes into a qualified intermediary account so that they do not have physical access or constructive receipt of the funds. And that way they can actually defer the taxation and redeploy all of the funds into a new piece of real estate held for trade, business, or investment anywhere in the US. So this is a reallocation opportunity. Now, if a person just doesn't want to pay tax, if that's their goal, then don't sell the property. If you don't sell what you have, you're not realizing any gain and there's no need for a strategy, right? But if you're no longer in alignment with the property that you're holding, either you've got cash flow issues, or maybe you don't like that location anymore, or you want to diversify, upsize, upgrade, whatever it is, if you no longer want that asset, rather than just selling it, cashing out and paying substantial taxation and then having a lot less money to reinvest, there's this opportunity to snowball your wealth, right? The equity that you've grown in this existing property, use this 1031 strategy to reinvest in a new piece of real estate, and you get to use the full force of all of what you've grown in the existing property. So, in order to do this, though, you have to use a qualified intermediary and you have to adhere to the timelines and the guidelines within the tax code. So there are some pretty strict rules about how this transaction plays out. You do have to reinvest the money in a 180-day time frame. And the first 45 days of the 180 days is your identification period. So you have to unambiguously identify what it is that you're going to be reinvesting into by midnight of the 45th day. So in reality, most people don't even wait for that clock to start ticking on them, because the clock starts ticking when you close escrow on the sale of the relinquished property. Some people call that the down leg property. So when you close escrow on, that's what triggers that 180-day clock with the 45 days to identify at the beginning of that 180 days. So what happens in the real world is most people, as soon as they secure a buyer on the property that they are relinquishing, then they will get out there and they'll start writing offers on replacement property. They'll just write those offers contingent on the close of the relinquished property. And that way they are not required to buy that property unless they truly do close on the one that they're selling. Okay. So we are the ones that supply that 45-day identification form to the exchanger. So, as the qualified intermediary, that's what our company is, a national qualified intermediary. We supply an identification form to our exchanger, and it is due back to us no later than midnight of the 45th day. And there are three different ways for the exchanger to actually fill out that identification form. The first one is probably the most popular one. It's called the three property rule, and they can list up to three properties, any fair market value, anywhere in the US, as long as it's going to be real estate held for trade, business, or investment. If they list three properties, they don't have to buy three properties. They can have an intention to buy only one, but they decide to list three so that they have a couple of backups on their list. Because after midnight of the 45th day, they cannot change the list for any reason whatsoever. they must buy something off of the list. So if they are at day 120 and they don't like any of the properties on the list that they provided by day 45, then they've got a blown exchange if they don't buy anything off of the list. It has to be something from the list. Now, the list has to be unambiguous. So it has to be literally addresses or parcel numbers. It can't just be, oh, I plan on buying an industrial building in California, for example. It has to be unambiguous. So if it is a condo, it even needs to include the actual unit number in your identification. If you are buying a fractional ownership in, say, a tenant in common or into a DST or any other fractional ownership, you have to actually identify the address and the owner and the percentage that you're planning on purchasing. Okay. So it has to be unambiguous. It has to be exact. So there is the three property rule. That's probably the most popular. But if you want to list more than three properties, you can do that. But then you are capped at the fair market value of what you, of 200% of what you sold. So for example, if you sold or relinquished $1 million property and you want to list more than three, you're now capped at $2 million because that's 200% of the fair market value of what you sold for your entire list. So it depends on what value are you selling and what market are you shopping in and what do the values there look like, whether or not it makes more sense to go with the three property rule or the 200% rule, because obviously you're going to want to choose the option that gives you the most flexible list, right? There is one other rule, it's called the 95% rule, and that says that you can list more than three, you can exceed 200%, but then if you choose the 95% rule, it says you must buy 95% of the fair market value of the entire list. So we rarely see anyone use that one because it's a kind of risky to assume that you're going to be able to close on
You
everything in
gotta
your
buy
list.
them all. You gotta buy every single one,
You
or
have to buy them
overpay.
all. Exactly. People don't usually choose that one. It's a rare occasion, but it does exist. Yeah.
All right, so let's play 1031 ignoramus right here. I'm gonna be
Okay.
your, hey, this is, you messed up. Okay.
Okay.
Hey, Jana, I'm selling my house. It's worth $2 million. I think I might want a 1031. I've lived here for 30 years. Can you help me set up a 1031?
Oh, goodness. Okay. So you said this is your primary residence. Is that
Yeah,
correct?
we raised our babies here. We love it.
Okay, so unfortunately, 1031 exchange does not apply to the principal residence. You might consider talking to your tax advisor about the 121 tax code. The 121 tax code is an exemption that applies to a primary residence as long as you can claim that you lived there 2 out of the last 5 years. Then you can claim an exemption on the capital gains as long as it doesn't exceed 250 if you're a single person, or it sounds like you're married filing jointly, so then you would have up to $500,000 exempt. Okay, so 1031 exchange is only applicable to real estate held for trade, business, or investment. Okay, so then you might say to me, I made $2 million of gain. I only had 500 exemption, right?
Yeah, I've got like a $2 million gain on my house, Jana, and you're basically saying I can only claim 250 for me, 250 for the wife. Does that mean what do I do with the other 1.5 million?
Yeah, that's a good question. So, a lot of times people will reach out to their tax advisor to maybe explore some other tax deferral options. We do sometimes see people talk to their tax advisor, and then they might get some advice to potentially move out of that property, convert it into an investment property for maybe a couple of years. You're going to want to definitely follow the guidance and direction that this tax advisor gives you for documenting the use of the property so that you can show still that you can claim it as your primary residence for 2 out of the last 5 years. So you don't want to rent it out too long, but you want to rent it out long enough that you're showing that it was held for investment. And this opportunity might afford you the ability to take advantage of both tax codes upon the exit, because now that it became an investment property, as long as it's not an investment property too long that you lose that exemption, you might be able to take advantage of the 121 exemption and then push the rest of the gain, the rest of the monies into a 1031 exchange and use those funds to buy investment property. So you can't use 1031 exchange gains or 1031 exchange money to buy a new primary though. that is also a violation of the tax code. So you can't exchange out of something you're currently living in. The only way that you can exchange is if you move out and you turn it into a rental property long enough that you can show that it was held for investment. Okay. And you cannot use the money that went into the exchange account to buy a new primary residence. That's a restriction.
And you guys aren't in the business of saying, hey, this is how you qualify something being held for business purposes, business or trade. You would say, talk to your accountant and follow their guidance.
Absolutely. Because we, as a QI, obviously we're not the tax advisor for this person. We educate them on the tax code. We tell them about what we're seeing in the marketplace and some of the nuances. And we'll definitely point out red flags that we see people approaching with. But we always defer to the tax advisor and the legal advisor that's working with this exchanger because obviously that party has the bigger picture. They understand all of the things that this party's done during the ownership journey of that property. They have been documenting the usage of it. They can see what income's been produced. They can see what depreciation was taken, et cetera. So they really need to lean on that party for the advice about their specific set of facts and circumstances.
And if someone comes to you and they're like, I don't have an accountant, this is the first transaction, this is my primary, like this, I've got one rental, I've got my house, this is my home, this is my rental, right? It's going to maybe qualify, but like I don't have an accountant. Do you guys have people you like and trust?
Absolutely. Yeah.
Okay.
So a couple things. One is we do have some tools on our website so somebody can do some preliminary calculations themselves if they want to, but we always recommend that somebody talk to a seasoned professional, CPA, enrolled agent, somebody who tax attorney, somebody who has the skills to do the math for them and based on their profile and their tax brackets, et cetera because obviously people sometimes have passive losses. There's a lot of different things that play in to an overall tax profile, right? And you've got it on your whiteboard, right? So it is a lot to wrangle and people if they don't have a tax advisor, obviously it would be great if they got one. If they need a list of tax advisors in the area that they reside, we're always happy to provide that.
Now, let's say I was working with you. I'm like, okay, let's do this. We've got a rental property. It's held for trade or commercial or business, whatever three qualifications you said, right? I've got this property. I want to do a 1031 exchange. We go out and we identify four or five properties, enough money, enough value. And let's say that my total 1031 forward is 1.5 million, right? And I just don't want to close on the last 300,000. What is not closing on a piece of a 1031? Let's say I push forward 1.2 million, but at the end of the day, I'm just like, dude, this house has problems that I didn't think it had. I
Yeah.
identified it, but I don't want to close on it. What happens if I push most of the money forward, but not all the money?
Yeah, so that's called a partial exchange, and you can certainly do that. One of the misnomers out there, people think that it is a requirement of the tax code that you buy of equal or greater value to your net sales price, and that is net of transactional costs. That is not a requirement. That is if you want full tax deferral, then it's a requirement, right? If you're open to paying some taxation, you can relieve yourself of part of the debt component of your exchange, or you can decide to pocket some of the what we call cash boot and not reinvest all of the net equity. You can decide to do that up front if you want to. So if you go into your exchange knowing that you are going to take a portion of the proceeds and pay taxes on it and only push a portion into the exchange, you're allowed to do that up front. You can exclude monies from the exchange from day one, and then it'll come to you immediately. But if you're in a circumstance like you're describing where you think you're going to exchange all of it, you let all of it go into the QI account, and now you decide only to partially reinvest, and then some of the monies are going to be in that exchange account and they're not going to be reinvested by day 180, then on day 181, we return the funds to the exchanger. So whatever hasn't been spent will come to them, and now those funds will be taxable. And so in preparation for that, it's a really good idea for them to talk to their tax advisor to see what the ramifications are going to be on that portion.
Yeah. And so that's more of a matter of there's basis, what you paid into the property, there's substantial improvements, what you improved on the property, there's your depreciation, which is counteracting that, there's recaptured depreciation, counting like back countering against that. And then against all of that, you're saying, hey, you're going to push this amount of money out to you. You should talk to your accountant. Like
Yes.
you've to have more, you've got to have a plan, right? Me and Jana are talking about 1031s, but the greater conversation is, hey, you've got to have a plan going into this because it can get hyper hairy hyper quickly. Does that sound like
That
a
is
fair?
very true. Yes, yes, because the things can change over the course of the exchange timeline, and being prepared for pivoting and knowing what the consequences are of each decision you're making is a wise thing. In our world, we love it when people come to us and talk to us about their exchange before they even list the property that they're going to relinquish. That's the ideal, right? They call us and they say, I think I want to do an exchange. I'm contemplating listing XYZ. This is what I think it's worth. This is how much debt is currently adhered to that property. This is where I'd like to reinvest. This is my plan so that we can walk them through not only the mechanics, but some of the pitfalls and warn them about the different things that could go down so that they are educating themselves. Because the people who plan ahead have far more success in a 1031 exchange, right? They better meet their financial objectives. They better meet any personal objectives if there's some logistics in play on their decision making. And so they're going to have more success if they plan ahead. Now, in reality, sometimes we get phone calls from people who did not realize that selling investment property is a taxable event. They had no discussions with their accountant. They had no discussions with their realtor. And now they are at the close of escrow, literally sitting with the notary, signing their closing documents, and the 593C form comes out, and they are filling out this form. And now they've realized, wow, there's going to be withholding, there's going to be tax implications. Oh my goodness. And so then those people sometimes will call us and they'll say, is there anything I can do? Because I did not realize this was going to be a taxable event. And so we will help them set up an exchange. They can halt the closing. And of course, then they have to deal with the other party sometimes and ask for an extension. They might need to ask for the right to assign the contract because when you do a 1031 exchange, it really is an assignment of the contract. We, the QI, the qualified intermediary, we're actually stepping into that contract so that we can catch those proceeds. And there's usually some additional documentation that needs to happen at the last minute. And those parties honestly don't usually have as much success with their exchange because they didn't plan on an exchange. They're trying to do a
Yeah.
last minute exchange. And now, as soon as it closes, that timeline starts ticking on them. The 45 days goes by fast when you had no idea you planned on doing an exchange, and suddenly you're out there trying to find replacement properties quickly. So, again, in the ideal world, we'd like to know about it ahead of time because then everyone is empowered. Their realtor or commercial broker, whoever's handling the sale, can be more strategic in negotiating and trying to make sure that all the timelines are going to sync up with the exchange. So that is really a better avenue, but we can certainly help people last minute if needed.
I agree with you 1,000%. Like this for property 1031 exchange. Now, one of the things as an investor, like a professional investor, that I would call everyone's mind to is good deals don't grow on trees. You have to work to find a good deal. You have to do a lot of analysis to find a good deal. Like we bought 7 properties for this one investor, and just one of those properties that we bought for 1,060,000 just appraised 6 months later for 3.7 million.
Wow.
The reason we were able to do that is because we looked at hundreds of properties.
Mhm.
We, from the moment he said, "Hey, I'm interested in a 1031 exchange," we started looking at properties and seeing if we could find like what is good in the market, how does the market work, what is good cash flow in the market, is he going to want Airbnbs? Okay, what size properties in the market he's interested in, is he going to want to be in? Like we started working months before he even got an offer. And so by
Ah,
the time he got an offer, we had a really crisp understanding of, hey, in the market where he wants to be, in the
mhm.
conversations that we have had, this is what he's looking for. And so the moment he had an offer, he had a 60 to 90 day close on that, like a 60. They just kept getting bogged down in financing, this, that, and the other. So we were running that whole offer to close time period looking for houses, right? Then he closed. And by the moment he closed, we're like, we want this house. So we went to our qualified intermediary and signed all the forms and said, here's our addresses here. We identified like 10. And then at the end of the day, we closed on, I think, 7 of those. But I think Jana is understating the case a little bit. The earlier you can get involved with your team, the earlier you can know what you're going to be buying, the earlier you can have your 1031 exchange custodian involved, the earlier you can have a conversation with your accountant. The number one problem I see with 1031 exchanges is that people just start the conversations too late.
Absolutely.
And it
That's
just
the
makes
number
it.
one problem I see as well.
If you enjoyed that clip, it's just a little tiny piece of a long, nuanced conversation we were trying to have on this subject. That link is at the description below.